$10 trillion is quietly leaving the Western financial system, and most models only just started detecting it. This is not a rumor. This is not a fringe forecast. This is showing up in the actual flow data, in the sovereign debt demand numbers, in institutional rebalancing reports, in quiet decisions inside asset management firms. And here is what makes it truly unsettling. Early movers have already repositioned. Are you hearing about this early enough to understand what it means? Or is the shift already locked in? This is not a market crash, not a panic event, nor something that triggers emergency meetings. It is something slower, more structural, and far more dangerous. Slow shifts are the ones nobody prepares for until it is too late to respond. On the surface, everything seems fine. Markets function, governments issue debt, banks report normal conditions. That surface stability is real, not fabricated. But capital does not wait for the surface to crack. It moves before the surface cracks. That is the entire point. The signal you need to watch is not the headline. The signal is underneath. And right now, underneath, capital is already gone. To understand where it went and why, you must understand how global money actually moves. Not randomly, not emotionally. Through 3 specific channels determining long-term wealth. 10 years ago, all 3 channels moved toward the West. U.S. Treasuries, European sovereign debt, into equity indices of London, Frankfurt, and New York. The West was the destination. The rest of the world was the risk. That was the consensus, the model, and it held for 40 years. Then the model started changing. The people who built it were the last to admit it. The first channel? Sovereign debt markets, where governments borrow by issuing bonds. Institutions park capital for yield and stability. Western sovereign debt was the safest asset, the benchmark, the default. Today, that assumption is stress-tested like never before since the 1970s. The second channel? Institutional investment flows, enormous rivers of capital managed by pension funds. Sovereign wealth funds and insurance companies manage capital for millions of ordinary people. These institutions don't move fast, but when they move, they reshape entire markets, and right now they are moving. The third, long-term capital allocation, multi-decade decisions for economic growth. Where to build, where to lend, where to position for the next generation. This is the slowest moving capital. When it moves, it's not a short-term signal, it's a verdict. Right now, all 3 channels point in the same direction, not dramatically, not all at once, but consistently, and in a direction that has historically been very difficult to reverse once it reaches a certain velocity. 10 years ago, the same institutions now rebalancing away from Western markets were arguing for Western exposure. They were overweight U.S. Treasuries. They were expanding into European equities. They were publishing research that called Western financial dominance structurally permanent. That same research is now being quietly revised. So why does any of this matter to you personally? Because this is how a slow capital shift eventually shows up in your mortgage rate. It shows up in your government's borrowing costs, which determines what gets funded and what gets cut. It shows up in the expected return on your pension, quietly revised downward by institutions. When demand for Western sovereign debt falls, governments have to offer higher yields to attract buyers. Higher yields mean higher borrowing costs. Higher borrowing costs mean less fiscal room. Less fiscal room means pressure on systems, healthcare, infrastructure, public pensions. Millions depend on these without ever thinking about where the money comes from. This is not theoretical. This is the arithmetic, and it is already running. So what is actually driving this shift? What is pulling 10 trillion away from the most dominant financial system? The answer is not panic, not ideology, not geopolitical posturing. The real driver is something more precise and more structural than any of those things. It is relative opportunity. Capital does not need to believe that Western markets are failing to start moving away from them. It only needs to believe that somewhere else offers a better risk-adjusted return. And the uncomfortable reality is that for a growing share of the world's most sophisticated long-term investors, that belief is no longer a contrarian position. It is becoming consensus. Debt to GDP ratios in major Western economies have reached levels that would have been considered crisis thresholds a generation ago. Demographic aging is creating fiscal pressure that no government has fully solved. Growing populations of retirees drawing on systems built for a world that no longer exists. The real return on Western sovereign debt, after inflation, has compressed to the point where it no longer justifies the allocation it once commanded. And each year that these conditions persist, the differential grows larger. The exit calculus becomes clearer. Against that backdrop, other parts of the world are becoming increasingly attractive on a relative basis, not because they are perfect, but because the gap is closing in ways that matter to the models. The first destination is emerging economies, where growth is still accelerating. Countries across Southeast Asia, parts of the Middle East, and certain African markets are attracting patient, long-horizon institutional capital, making a structural bet, not on a single election cycle, but on decade-long demographic and economic trajectories. that are simply not available in aging Western economies. The second destination is private credit. As Western banks pulled back from certain lending activities, private credit funds stepped into the gap, and the yields they offer are significantly above what public bond markets can provide. Capital is flowing here at a pace that is quietly reshaping how the global economy gets funded. And it is doing so outside the visibility of the systems most people use to track financial risk. The third destination is alternative and real asset structures, infrastructure funds, commodity-linked vehicles, multi-jurisdictional platforms designed to operate independently of Western monetary policy and interest rate cycles. These are not speculative vehicles. They are designed for exactly the kind of long-term institutional capital. That is, looking for a structural exit from Western dependency. A decade ago, these asset classes were considered peripheral, interesting for diversification, but not serious alternatives. Today, they are receiving primary allocations. The fringe has become the strategy. The question that remains, and the one that Western financial policymakers have not yet answered convincingly, is what happens next. Can Western systems adapt fast enough to reverse this? Can they deliver the returns, reduce the structural risk, and restore confidence? That would cause institutional capital to stop moving, or even return. Based on the current trajectory, and based on the structural forces that are driving it, the honest answer is not quickly. Possibly not at all, without changes that go far deeper than anything currently on the policy table. The financial world is rebalancing. The center of gravity of global capital is shifting. And the people, institutions, and governments that understand this clearly, not as a crisis, but as a structural reality, will be far better positioned for the decade ahead than those who are still waiting for the surface to crack before they start paying attention. Because right now, the capital is already moving, and there is no sign it is slowing down.